So, the debt limit agreement sketched out between Joe Biden and Kevin McCarthy is off to quite a rocky start in Congress so far. With June 5th looming as the date that the Treasury won't be able to pay the bills, McCarthy and Biden both seem confident about the bill passing through Congress on Wednesday evening, which is tonight as of making this video. But there are some mixed signals coming from hardline Republicans who feel that they gave up too much in the bill, and then progressive Democrats who also found a lot of dislike in the bill as well. But on the bright side, there's a little more breathing room for the Treasury as its cash reserves climbed from its lowest levels since 2017. And it looks like the markets may seem a little more confident with the deal passing before the X date actually expires, as yields are starting to drop on these shorter term yields. So thankfully, over the last couple days, really over the weekend, there was kind of this implementation of a deal that was supposed to go to Congress in order for them to pass it so we can raise the debt ceiling. But there are a couple of debt ceiling threats. Now, the debt ceiling deal will be heading for the House vote on Wednesday, which is tonight as of making this video as it comes out, after passing through the House Rules Committee on a 76 margin. Now, the problem is that Republicans from Texas, North Carolina, and South Carolina are claiming that the deal granted too many concessions to Democrats. And the reason that that's a problem is because, one, they're most likely going to vote against the bill. But if they can round up enough people to vote against it, there could be possible delays or even derailments with the deal. And with June 5th looming so close, they really can't afford this. So the first thing is the spending levels. Now, Republicans don't think that enough spending cuts were negotiated in the deal. However, this section can pass through with just the help of the Democrats. Obviously, the Republicans wanted to cut more spending out of the deal so that way we don't spend as much money and get ourselves into debt much faster. Now, another really big thing was food stamps. Now, for the Republican side, they say that they want to raise the requirements or the work requirements in order to get food stamps. Now, the biggest things for this is that they think it's going to urge or encourage people to go get jobs, and it'll save money for the government without having to give free food to, which I know sounds bad, but to some people who take advantage of the system. And it'll help out people who actually need it by giving them more resources. And then obviously on the other side of things, they believe that there's no evidence or proof that any of these will actually happen. And so that's one side of the story that is also a possible derailment of this bill passing through the House. Now, of course, there's a lot of other small parts, but with the date looming so close, it's really hard to believe that they would probably delay or derail this entire thing just because of a few things that they didn't want in the bill. Now, both sides are compromising for things, but again, it's because that date is literally June 5th, which is next week, that I'm pretty confident, and again, the market is pretty confident that we're going to pass by. Now, it seems as if investors are a little less on edge with lawmakers making it to the final stretch of the debt ceiling deal. However, the Treasury is still preparing for the worst case scenario of defaulting on their loans, and here are some key points to consider. First is breaching the debt limit. Yields on Treasury bills maturing in the first half of June fell after a deal was implemented to be passed onto the House, showing some confidence in the markets that a deal will hopefully be finalized before we actually default on our loans. But the payments that are due on June 6th by the Treasury would actually force the U.S. into default because we just don't have enough cash in the reserves, which we'll talk about in a little bit, and that's what would default us. So that's why June 5th is that X date. Now, if we actually look at the debt limit and the amount of money that we're reaching, obviously you could see the debt limit is continuously raised over and over and over again, this being one of the largest raises in the debt ceiling. But as you could see, we've already reached that point where we're going to default on our loans, and June 5th being that X date where we are actually going to run out of money. So again, as we look down into the future, this graph is just going to continuously get larger and larger, and we're just going to continue to face the same problem. But again, as of right now, this is basically what the chart is looking like. As we talked about before, when you take a look at the shortest dated treasuries, they typically demand a higher yield to compensate for the higher risk associated with a possible default. So when you're looking at the 3-month or the 1 year, they have higher yields because there's more risk associated with this potential default. But there has been a healthy drop in the yield, suggesting that investors are confident that we could actually get a deal finalized soon. And again, when we're talking about the 6-month yields, what we see is that there's a massive rise because investors aren't as confident that the deal is going to get passed around at this point. But then when you do take a look, like 6 months ahead, right around this point, you can see that the yields do drop from around 5.3% and they fall all the way down below that 5% mark, getting close to 4.5. So almost a 1% drop in the short-term dated yields. And this shows a sign that the markets and investors are more confident that a deal will actually get passed. Now, one thing to note is the cash balance held by the US Treasury. And as of Friday, which is just a few days ago, the balance was down to just $55 billion, which sounds like a lot of money. But when the US Treasury has to pay hundreds of billions of dollars in debt owed and just in interest payments alone, that doesn't really seem like a lot of money. To put it into perspective, think about if you had your monthly bills where you had your mortgage, your car payments, everything that you had in normal life, and you only had $55 in your account. That's kind of the same circumstances that the Treasury is actually going through, but just on a little bit of a higher scale and a little bit more of higher stakes. But the interesting thing is that the Treasury said that they are focusing on quote unquote extraordinary measures in order to raise more money. Now, what that actually means, I don't know, but I can only assume that it's things that may look like some accounting errors, or they're adding extra zeros to a few places to eke out a few dollars that actually don't exist. But again, let's see what happens from this point. And like I mentioned before, these are levels that were the lowest since 2017. The last time that we reached over here was around the end of 2021. But just as of recently, we actually reached lower. And so that is kind of an issue, because this is kind of the same chart that we're going to be seeing over and over and over again, where we do get kind of this debt ceiling raise, and then we get a little bit more cash on hand. But again, as more debt gets accrued, as the interest payments go up, as we continue to spend more money without actually bringing in more money, the downfall is that we continue to lose cash in the Treasury until we reach a point where it gets very, very low, and then we're going to have to raise the debt ceiling, find new ways to make money, or, like how the Treasury likes to put it, find extraordinary measures to get more money. Now, like I mentioned before, if we're looking at the charts, don't get too confused by all the lines. What they basically mean is that the blue line right here is the 3-month yields on Treasuries. The orange line is the 2-year, and then the red is the 10-year. Now, when we're looking at shorter dated Treasuries, basically like the 3-month, the 1-year, the 2-year, the higher the yields, that's because they're compensating for more risk associated with the government. And again, you've probably heard of the yield curve, where typically you want longer dated Treasuries or just longer dated investments to provide more of a return, because you're putting your money in there for a longer period of time. So typically in a normal, healthy economy, you want your 30-year or your 10-year yields to be a little bit higher than your short-dated ones, like your 2-year or your 3-month. When it inverts, which is exactly what we're going through right now, when your 3-month yields provide a better return than your 10-year, then you have to ask yourself, why would I want to put money in for longer with less returns? It doesn't make sense. But the reason that they're inverted like this, and the reason that the 3-month is sitting at 5.4% and the 10-year is sitting at 3.6%, is because of the risk associated with the U.S. government. Now, one thing we do notice is that we do have somewhat of a drop. So this is on the daily. So just in the last couple of days, when the debt ceiling agreement kind of came through the House, or between McCarthy and Biden, really, you saw that on the 2-year and the 10-year, it actually dropped, showing a little bit more confidence that, yes, we're going to demand a lower yield because we think that it's actually going to pass. We don't think that the United States is going to default on their loans. And so therefore, we're going to demand a little bit less of yields, which should be good, because as these shorter term yields drop, we should actually see the yield curve invert back to its normal healthy economy ways. But again, the 3-month is still sitting at quite a premium all the way up here at 5.4%. But again, once the deal actually gets passed, maybe it'll follow suit and actually start to drop off, which kind of puts it back into more of a healthy spectrum. But again, we still do have quite a ways to go, because if you date back all the way over here to just around December, or really January of 2022, you could see that's when these short-term yields really started to take off, going from 0.052% in just around 18 months to 5.4%. So just to put that into perspective. And again, lastly, the one thing that I wanted to look at is when you talk about these types of things, when you think about Bitcoin, you think about it as a safe haven. And it'll be interesting to see what happens. So we have kind of really two scenarios playing out here. Right around here, right in March, this is where the SVB bank collapse happened. And as you could see, Bitcoin actually was a safe haven for this, pumping with a massive candle, showing that people were basically putting their money into Bitcoin because they thought it would be a safe haven. Now, it'll be interesting to see if the debt limit is raised and it passes and we don't default on our loans. What is that going to mean for Bitcoin? Is it going to rally kind of in like a congratulations, maybe back to these highs, to the hypothetical level of 30,000, which is a massive psychological number? And then again, there's the possibility where we do default on our loans. And then at that point, what happens? I think that's where, there's the possibility of one more leg down to 22,000. And depending on how bad it is, how bad things happen, obviously we could fall even lower back to around these levels in between like 15 and 18,000. So it'll be very interesting. I personally don't think that we're going to default on our loans. I think it'll be fine. I think we could see just kind of like this short-term relief rally to 30,000. Maybe we top out at this point, and I think we will fall back down below, maybe even to the levels of around 22,000, but only time will tell. And until then, I'll keep making these videos to try to keep you guys updated. But until then, I'll see you guys then. Peace.